Hi, I'm Ken Heyman. As Managing Director of the Advisor Institute at AllianceBernstein, I meet with financial advisors every day. One thing I hear expressed over and over is their frustration with how much they are juggling. The advisors I talk to are constantly trying to balance competing priorities, from managing client relationships to prospecting for new business, and of course, the tasks of leading their team. This problem of juggling is why we created the AllianceBernstein Digital Coach. This is a proprietary tool that draws on the wisdom of behavioral economics and unique perspectives from the Advisor Institute's practice management experts. In less than 10 minutes with the Digital Coach, you will be able to identify and prioritize the top needs of your practice. And armed with those insights, you will be well on your way to tackling the challenge of limited resources while positioning your business to seize opportunities for growth. Let the Digital Coach guide your journey to success. Visit abfunds.com/go/digital coach. That's abfunds.com/go/digital coach.
Welcome to Secrets of Successful Advisors with Ken Heyman, the podcast where we take you behind the scenes of the Advisor Institute to let Ken dive deep into the habits, mindsets, and strategies that set our best financial advisors apart. I'm Scott Tatum, and today I'll be talking with Ken to explore his thoughts on reasonable portfolio recommendations in unreasonable markets. Now, look, before we begin, let's cover some quick podcast news. If you've got ideas for future episodes, we would love to have them. Just go to my LinkedIn page or Ken's. If we use your idea, we'll be sure to give you a shout out on the podcast. Second, many of you look for specific topics of prior episodes, but we know this is getting more challenging as the topic list is growing. So to mitigate that, we are migrating all of our episodes over to the AB Digital Coach. Just Google Digital Coach AllianceBernstein, and it'll take you right there. Once you are there, you can serve all of Ken's fine work by practice management category. That should make it a lot easier to find stuff. Finally, I'd like to draw your attention to an important service from our sponsor, AllianceBernstein. Today, we'd like to highlight the podcast Uncommon Capital. Uncommon Capital comes from our alternatives investment team, and what they do on that podcast is fascinating. They bring some of the real thought leaders from around the industry that work on how to analyze investments outside of the normal 60-40 equities and fixed income portfolio. I think it's really worth a listen. Uncommon Capital is available wherever you're listening to podcasts. Now, let's get back to our podcast today. Ken, we want to get our listeners in the right frame of mind as we step behind the scenes of our practice management unit. You can't delve deeply into the psyche of clients or advisors while dwelling in our busy world. So let's leave that outside world behind for 25 minutes, look deep into human behavior to explore the science of clients, setting instincts aside so that insights can guide. And when we think about behind the scenes, Ken, that is where today's topic comes from. Because we were at our sales conference recently, and the sales conference traditionally kicks off with our chief portfolio analyst. And he did a very, very thoughtful, very deep dive on market conditions. And when we stepped out of the room and looked at each other as a team and kind of went through it, we went, wow, that was really insightful. And is that going to be difficult for advisors to act on? And so I want to start with a brief recap of what was said. Generally, what our chief strategist said is that markets are extended. You can really think of that as being a bit unreasonable, and that we need to be very thoughtful about the actions that we take. We need to bring in expectations, and we need to be very thoughtful about taking some very, very minute, small steps, picking up nickels and dimes to cobble together alpha. And so when we looked at each other and had that debrief, what was it about the message from a behavioral science standpoint that you said, this is going to be tough for advisors?
Well, I think you framed that hour and a half presentation pretty darn well, Scott. Rick was laboring and in a very systematic way to show how 50, 60 years of economic, demographic, geopolitical trends and forces kind of allow us to look at the marketplace and understand where we are in terms of a collision of very powerful forces. And there isn't an advisor listening to us that hasn't been exposed to many of these themes. But what he was doing was kind of offering from this historical, deep, analytic, very cognitively based perspective some observations about what expectations would be reasonable going forward. And on the basis of that, if you come to that conclusion that we may have to modulate our kind of emotional desires and accept that it may be harder to get to meaningful return, and there may be volatility that could really affect a portfolio, especially a portfolio for someone who's in retirement, who is now dependent on that flow of return, that there could be some consequences that would be difficult. Now, no one disputes any of the observations. There's really no way to make an argument that these cognitively refined observations that are well buttressed in the research, again, nobody on the podcast is unaware of these observations. They're not unique to AllianceBernstein, though we may have a particular perspective and some granularity that may be helpful for folks to be aware of. The challenge is in this idea that you describe at the beginning. You call this, our podcast episode today, Reasonable Portfolio Recommendations in Unreasonable Market. Well, the problem with that title and the problem with this approach is, what do you mean by reasonable? And now I sound like I'm being, I'm parsing words, but I'm not. I'm living inside the Advisor Institute world, which is the world of the behavioral sciences, and using insights from the behavioral sciences to help advisors improve their commercial success. And so when we think about reasonable, we have to remind ourselves that our good friend St. Daniel Kahneman revealed that human brains work in two distinct patterns. One is what he called the slow thinking brain. Everyone's familiar with these terms. This is the brain of logic and mathematics and future projections and planning. And it's a very slow, very energy intensive process. And this is, by the way, the brain that our chief strategist Rick was using to look at all these trends and then to come to conclusions about the future. All of those functions, looking at data points, drawing conclusions, looking at forward trends, all of that activity happens in the neocortex. It's very logic dependent. It's very confined and boundaried by mathematics, but it requires an enormous amount of patience, an enormous amount of time, effort, and energy to come to these conclusions. This hour and a half presentation that brought together an enormous amount of data, he labored on for months to bring it to this fine point. Okay. Well, as Kahneman reminds us, there's another part of the brain. That part of the brain is much less energy intensive, much more rapid in coming to conclusions, much more emotionally based, more impulsive. As Kahneman says, you're going to find it easier to answer the big questions you're facing, but the problem is you may not be actually answering the question that you've been asked. And a good example of this, I was watching Rory Sutherland do a presentation recently. He talked about the fact that by putting animals on requests for funding, like envelopes that a nonprofit would send out requesting funding, even if the nonprofit has nothing to do with animals, but the animals on the envelope stimulate a higher degree of response from the humans that are donating, right? So they have found just by testing that animal pictures are motivating of donations. And this is not a cognitive or rational decision that these humans are making. And the question that they're answering is not, is this a worthy charity to donate to? The question they're answering is, do I like this picture of this cute animal? And because I like this picture of the cute animal, I am stimulated to make a donation. Now, there's nothing reasonable about that at all. And one of the things that the pure practitioners of behavioral economics, like Rory Sutherland, who's the vice chair of Ogilvy in England, but his whole career has been about marketing influence and using these insights to help organizations achieve their goals or desired outcome, right? So the folks that are deep in this world and making sense of it and using these insights are able to say, when you use the term unreasonable, the experience of the decision maker who's using a heuristic isn't that way at all. They're not self-aware that this is unreasonable. So when you said the title of our podcast today was Reasonable Portfolio Recommendations in Unreasonable Markets, I would suggest that the way most advisors, maybe not all, but most advisors would respond to his recommendations for modulating expectations, accepting that the trends are showing that we're way out overreached. We've flowed so much stimulus into the economy that has to be unwound in some way. And there's no one listening to the podcast that isn't aware of how much stimulus has been pumped into the markets. This is a key part of his presentation. There's no one on the podcast that's unaware that there's some consequence attached to that. And yet, as we observed following up when he made a series of very thoughtful recommendations, hey, you've got to be cautious about the sequence of returns. A big loss early in a sequence when you're dependent on the money, that can be devastating. And so we have to be cautious. We have to be thoughtful about our diversification strategy and reasonable or modifying in our expectations for robust returns. And none of that resonates with the mindset and the emotions of advisors who've experienced the last couple of years with incredibly robust returns. In fact, returns that had you anticipated them at the beginning of the year, folks would have potentially scoffed at your projection. And yet these last 2 years have been incredibly robust. And so these reasonable recommendations for modulating your expectations and approaching your portfolio construction a little more carefully, using sleeves and asset classes that may not be as exciting as the last couple of years have been with what do you call it, the Magnificent Seven. And again, I'm not a portfolio manager, I'm not an economist, I'm a behavioralist, but shifting gears to these modulated, more careful, more thoughtful, more reliable, less volatile, but also less likely in terms of the upside productivity is, well, from a cognitive perspective, if you take all this information in the case and then ask yourself, what's the risk premium I get by continuing to do what I've always done and run the risk that everything around me may change as we are anticipating in some ways it will? What's the risk premium you get for not being careful? The cost of that could be huge, but in the moment of making that decision, it feels bad. And the brain feels like those recommendations are unreasonable. That everything inside me that has experienced the last couple of years, what has worked well, watching colleagues who've been less willing to embrace these very socially approved, the vast number of people that are getting these big returns or celebrating that the small number of investments is just performing at such a magnificent rate that the adoption of AI is going to continue to fuel that for the foreseeable future, far beyond any immediate concerns. It feels unreasonable to get careful. It feels unreasonable. It feels out of sync. And that's the challenge. And where we first started with our conversation after that presentation, the challenge is not we think there's something wrong with his analysis, because his analysis cognitively is sound. A lot of effort went into it, and it held together really nicely, very nicely. But the feeling you get is the feeling of dread at actually executing that. And that feeling in the system one, the fast thinking brain, is what that part of the brain keys off on, not the logical argument that doesn't feel anything. It's just an observation. The feeling of dread, the feeling of loss, potential loss, the feeling of being out of sync with others, those feelings determine the willingness to go in a direction, to behave. So as a way of wrapping up this first kind of dive into this stuff, Scott, I use this example of the animals on the envelope. The feeling that those animals stirred up motivated a behavior. The feeling was positive, and so it was an attractor. In the same exact function inside the central nervous system of human beings, and believe it or not, almost every advisor we know is a human being. the feeling of dread, the feeling of basically, you can describe it as solution anxiety. We've presented a problem. Here's a good solution. The solution makes me anxious. That anxiety causes me to pull away from that solution. It's the same thing. Animals have nothing to do with donation. Anxiety about using, less exciting investments has nothing to do with making good investment decisions. That anxiety is being produced by a part of the brain that's not even making logical conclusions. And yet, these are the powerful forces that operate outside of our awareness and at least influence, if not, in fact, determine behavior. And it's really important in times like this when change is happening, but change isn't apparent yet. We're not in a new set of patterns. As we anticipate that may be shifting, overcoming that non-rational, or we could call it unreasonable, way of making decisions for advisors, I think is really important for them to at least become aware of and start experimenting within their thoughts.
All right, Ken, I want you to drill down. I want you to take those principles and I want you to drill down on a very specific observation that our friend and colleague Rick made. Because, if I'm characterizing the first part of that 90-minute presentation, he wasn't telling us to leave the party. He was telling us to be the reasonable person at the party, right? That's the way I characterized it. Is that there's a lot of people having an awful lot of fun here, and maybe fun that they are going to regret. You should participate in the party, but you need to be the thoughtful voice of reason. So when you take those kind of general comments that you made and you apply them to that very specific incident or that very specific observation, what kind of guidance can you give our advisors that are listening today?
Well, let's start with the first question embedded in what you're saying there, Scott, is, why would it be hard for an advisor to let go of chasing the returns they've been getting why would it be hard for them to shift gears on the basis of a compelling argument that the prudent investor at a point of time like this, with these trends indicating, these numbers revealing, these ideas prevailing, this amount of time for us to be off any kind of sense of the mean of long-term behaviors, this much stimulation in 5 different tranches of stimulation over the last 25 years, what would make it hard for somebody to step away? I mean, that's the pretty compelling argument. And as I said, everyone listening to this has had that compelling argument. Well, it comes back to this, how these two brains operate. It's hard to spend the time to really go cut through all that information. And when you do, you come to this conclusion that's, kind of disappointing. There are times when the markets are not going to outperform. There are times when the market needs to correct. The forces require correction. There are times when investments are an expression of euphoria. We've talked about this, and we can look back in time and remember when this was happening, unreasonable enthusiasm kind of thing. But I'm reminded, because you use the term parties, I'm reminded over the holidays, I went back to my hometown and I was showing my 2 grown children some of the places I used to go, where I went to school, things like that. And we were driving down one main road in my town, and I suddenly had this massive recollection of going to a party. I was in high school and I was, in my senior year, and one of my friends, a young woman, decided that she was going to kind of have her breakout opportunity. Her parents went away for a long weekend, left her at the house. She was old enough to be left at the house alone, and she decided, perhaps not very wisely, to have a party in their house. And she invited, 10 or 15 people, but everybody found out about it. And before you knew it, the place was packed with people. And I got there with my little group of buddies at the peak of the packedness, right? And so the house was just overfull. And she was, happy that she was now the popular one and unhappy that there was a lot of people in her house. And so we kind of wedged our way in, and there's too many people on the main floor. So we went down to the lower level of the house, and fewer people down there. And we're hanging out for maybe 20 minutes. And all of a sudden, there's this crash. And somebody had bumped into somebody, and they had fallen into one of the display cases with her mother's collection of antique plates. And there was not just a crash, but then some very loud noises of distress coming from upstairs. And I looked at my buddies and I thought, this is not a place that we should stay. There were enough indicators and enough potential for downside risk that I said, it is time for us to exit the back door and not be here when the consequences of this event accrue. All right. In that moment, I was of my right mind. Instead of what a lot of people did was run upstairs to see what's happening, that was an indication to go in the opposite direction. And I was always that guy who was the one who was concerned about people being safe and that sort of thing. So I was sort of a buzzkill. But think of that as this mindset. All right, well, what's the other mindset? What's the prevailing mindset right now of people who've enjoyed the last 2 years, went all in on that Magnificent Seven investment, believe that AI is changing the world, so we're going to capitalize on it? What's the mindset? Well, it's actually a whole host of powerful heuristics that are combining to create that powerful emotional draw toward status quo. One of those things is what's called inappropriate extrapolation. Human beings tend to see what's been happening recently as something that's going to continue to happen. So I got a huge amount of return 2 years ago. I got a huge amount of return last year. It feels like it would be foolish not to continue to participate, even though anybody rationally will say, well, eventually trees don't grow to the sky. Eventually, these business models will reach some level of rationality. Eventually, the irrational enthusiasm will abate and individuals say, yeah, I've made enough money here, I've got to exit. There's a host of reasons when you're overextended that way where things are going to shift, but that inappropriate extrapolation feels compelling. There's another one, social proof. You look around and say, all the people that I know that have done what I've done, we've all prospered. I have colleagues who are, more bearish, more reserved, more cognitive, more careful, and they missed the boat and their clients are not happy. And so you have the social proof. And of course, there's loss aversion. If loss aversion cuts in two ways. One way is when I have a loss in my portfolio, I feel bad. And that is going to happen. No human advisor or investor is immune from loss aversion. We may cope with it. We may have some cognitive models that help us with it, but we are going to feel it. Well, it cuts the other way too. In fact, the reason when people leave the market because some correction has occurred and they're out of the market, they keep waiting for a signal to go back in, waiting for a signal to go back in. Well, there's no little bell that tells you when to leave and when to come back. You can look backward in time and say, oh, I shoulda, but there's nothing prospective that tells you when to do it. So typically you wait until you have enough bad feelings of loss that you exit. Well, how do you get back in? Typically what causes people to get back in is they see others benefiting and they start feeling what? Loss aversion. I need to get back in because they're benefiting and I'm losing. So how do you modulate your portfolio? How do you sit down with a client and say, look, I think we need to go defensive? Now, the fact is, many clients might resist going defensive, but if they respect you as an advisor, if they have a long-standing relationship of trust with you as an advisor, they will at least take you seriously, if not allow you to convince them. But now the advisor's got another problem, reputation risk. What if I'm recommending something to be defensive to protect my client and it doesn't go badly? And so my inappropriate extrapolation and my fear of loss aversion create this resistance. So there's an enormous amount of issues here that we can talk about and explore. If you're going to start modulating your expectations and then using a more complex, defensive, kind of reasonable approach to investing, this kind of, instead of euphoric expectations, reasonable expectations, and using the tools we have that allow you to make reasonable returns with less volatility and protect that client from those potential big losses, that's going to require you to broad frame and look more outside of what you're used to instead of the narrow framing and simplification that most advisors prefer. So, Scott, when we came out of that lecture, I remember vividly this horrible conflict inside we both had, which was, on the one hand, it was a beautiful and helpful, revealing explanation of 50-year trends coming together at this point in time and giving us a really compelling set of ideas about how we should be moving forward reasonably in a potentially unreasonable marketplace. And yet, when we step back into our world of behaviors, those recommendations feel unreasonable because they fly against what's been happening, what we see around us, what we wish will continue to happen. And it really requires us to work harder cognitively, which, as Kahneman pointed out, is something that the brain is reluctant to do. The brain wants to take the simplest course of action available. And I think that's really, Scott, why it's hard for advisors to move away from this kind of habit of pursuing what they've been doing over the last couple of years.
Well, Ken, we need to take a break there. But as we take a break, because we've really hit time, I can hear our listeners screaming, "You've defined the problem. You have not told me what to do about it." So I'm going to say we're going to carry this over to the very next podcast. And I want to talk about another aspect of it, but I also want to get into what advisors can do about it. Because I learned two things today. One is I learned that this is not just one heuristic that we've got to battle within ourselves when we find this kind of a recommendation. I also learned that teenage me would have profited from having teenage you along with me on a number of occasions. But let's go ahead and take a break there. Check out our friends over at Uncommon Capital, and please go to Scott Tatum or Ken Heyman's LinkedIn page if you've got an idea for another topic for another time. And thank you so much for listening to this episode of Secrets of Successful Advisors with Ken Heyman.